for everyone for joining us today. We'll let everyone trickle in here, and then we will introduce our guest and get going on the great content that we put together for everyone today.
Thanks, Maddie. Yeah, look, as you know, we've been nearly in existence for 3 years. Try to do a good job of sprinkling in both market commentary. You get plenty of that from other sources. We realize, but about 4 or 5 times a year, we try to take the direction of the discussion elsewhere, right? So today we're really lucky to have a couple of guests. Maddie will bring or introduce them formally in a moment. The genesis of this particular event is a function of the survey results. We sent a survey out towards the end of last year, and we saw a overwhelming number of clients ask to just better understand alternatives and crypto, especially in the aftermath of the election and the big run up in Bitcoin. So again, we're really happy to have some subject matter experts go over that information today. I just want to go ahead and provide some disclosures, kind of standard stuff. The information here is educational in nature. It's not to be construed as advice or solicitation of a product or service. We're happy to have the guests. The guests will have an opinion, and those opinions are their own, not that of Breakwater. That being said, if these specific topics are of interest to you and you want to really further explore them, we welcome setting up some time with Tom, Madeline, or myself, and we can kind of dive into more detail. All investments carry some degree of risk. Alternative investments in particular oftentimes have higher risk just to the nature of their structure, whether it's liquidity, trading volume, so on and so forth. So again, without further ado, Maddie, I'll let you formally introduce our first guest, and then I will introduce our second guest in the middle of our discussion today.
Appreciate it. Thanks, Jeff. Yeah, well, as Jeff had alluded to, our recent client survey revealed that we've had a lot of growing interest in these two particular areas, and for many investors, private markets and digital assets remain sort of an unfamiliar territory still. So we wanted to highlight these two topics. And so first, we are joined by Owen here, Owen Boyle, from iCapital, which iCapital is a financial technology company transforming access to alternative investments by providing an end-to-end life cycle operating system. And that empowers firms like Breakwater Capital to explore, invest in, and adopt different alternative products in a very easy way for both us and for our clients. Owen in particular is a vice president on iCapital's research and education team. He specializes in private markets. He has over a decade of experience in alternative investments. Owen helps investors navigate the complexity of private markets through research and education. Before joining iCapital in 2023, he spent 9 years in business development at a leading alternative investment, including different firms like Silver Point Capital, TPG, Angelo Gordon, and he began his career in risk management at a different firm structured through structured credit hedge funds, and later worked in structured finance advisory. Owen holds a BS in business administration with a concentration in finance from Georgetown University, and is a CAIA chart holder, which is one of the gold standards for what he does in particular in his industry. So, and I will let Jeff here introduce Adrian.
Thanks, Maddie. Adrian, I apologize in advance because that was a really great job of doing a bio. And so I'll keep it a little bit shorter. I'll let you do a little bit of an intro to more formally when it's your turn to speak. But we're very fortunate to have Adrian Fritz join us. Adrian is actually in Switzerland today, so he's getting ready for hopefully a cocktail after our webinar. He's the head of research at 21 Shares. 21 Shares is a large digital asset firm. They've been around for over 10 years with a global presence. Again, the idea here is we see quote unquote experts popping up in the world of crypto on Instagram and TikTok who traded crypto for the first time 3 months ago. That is not the story with the 21 Shares team. So they're going to talk a lot about what they've seen in the genesis of the market, really get you into understanding the actual blockchain and again, just really happy to have a deep discussion on all things crypto. Um, Again, Adrian's been in the business for 15 years or so, fintech background primarily, and so again, we're excited to have him take us through the view of the world of crypto. Owen, we'll turn it over to you to start the discussion today.
Great. Thanks a lot, Jeff and Maddie. And thank you all for your time today. And I've got a couple slides that I'm going to walk through with some prepared remarks. But if there's any questions that you have as we go along, please feel free to interrupt me, and can reserve some time at the end for Q&A as well. So yeah, moving to the next slide in terms of, what are private markets, right? Broadly speaking, private markets allow investors to access assets that aren't available through traditional public investments. Think stocks, bonds, mutual funds, but are really critical to the growth of both the domestic and the global economy. Typically, these assets are referred to as private since they are less liquid and not easily traded. And as Jeff had alluded to at the outset, right, they really come with an illiquidity premium, right? So we really break up private markets into three main food groups, as you can see on this slide, right? Private equity, private credit, real assets. So when sort of thinking about what is private equity, it's really another way of saying that you own the equity in a non-public company. And typically, the reason you're going to do this is the potential for higher returns through capital appreciation. These returns can be generated in a number of ways: organic growth initiatives, strategic acquisitions, maybe recapitalizing a company's balance sheet to improve capital efficiency. I would say of the three private market asset classes, this one comes with the highest degree of risk, but correspondingly, investors have been, rewarded historically with higher returns. Moving to private credit, this is most commonly associated with middle market direct lending, which is a sort of a strategy you'll typically find in a BDC or a business development company. And it's really what the strategy is you're usually originating or investing in the debt of a private company. This is usually done to a private equity sponsor backed business, right? So think about what I just mentioned with in terms of private equity. That private equity sponsor is using the debt for purposes like acquisitions, growth plans, recapitalizations. There are some other forms of private credit which we can talk a little bit more about if folks are interested. But I'd say this is really sort of the most common flavor today. Um, we like private credit because when you compare it to traditional fixed income markets, private credit is typically floating rate debt, also offering sort of enhanced yield with a similar risk profile. um, and you can also sort of argue that some of the risks are potentially lower given private credit instruments are typically held to maturity, and sort of the lack of public market pricing insulates investors from the volatility that you'll see in sort of more liquid and traded credit instruments. And as mentioned, right, the floating rate nature of these loans don't give you exposure to traditional duration risk that you would get in a fixed income security. And then the last leg of the stool are real assets, right? And I'd say a lot of times this is probably most commonly associated with real estate. So think a REIT. But these also include strategies such as infrastructure and natural resources. And really, what real assets are trying to do, is provide investors with uncorrelated returns, adding another layer of portfolio diversification. And typically, these strategies act as hedges against inflation. So these are really investing in tangible assets that help to fuel the global economy. Whether those are commercial properties, residential properties, power generation assets, pipelines, farmlands. Um, Real assets tend to be very sort of complementary to both private equity and private credit. And again, tend to exhibit lower correlations to sort of public markets. So if you sort of thought about these three at as sort of a Venn diagram, right? You'd have sort of private equity on one side, which is really giving you capital appreciation. You'd have private credit on another, which is really giving you, attractive current income, and real assets are sort of sitting in between. So we can flip to the next slide. In terms of the opportunity set, right, and one reason why iCapital is in existence and has been so for the past decade plus is, we continue to see greater and greater adoption amongst private markets, right? And so, looking forward, this is going to be a $20 trillion investable opportunity by the end of the decade. A lot of factors are going into this. Or including public companies staying private for longer, and just a shrinking number of public companies out there, as well as I think, most impactful to you is a growing number of, I would say, really sort of institutional quality products that are more tailored for the wealth community. So sort of making investing into alternatives simpler and more streamlined. And you can move to the next slide, Maddie. And then, this is really, I would say, kind of the proof is in the pudding, right? Why are folks interested in alternatives? And it's great that the asset base is growing, but what's really driving this and what's sort of driven this historically is the outperformance of alternatives when compared to traditional public markets, right? So you can kind of see over every time horizon on this slide, private equity and private credit have outperformed their public market counterparts of global equities and domestic fixed income. We would generally comp private real estate to fixed income as well, which also outperforms over each time period. And so, generally what we're seeing is that when investors add alternatives to a portfolio of traditional assets, they're usually getting not only an increase in returns, or the potential for increase in returns, again, be that capital appreciation or income, but typically also sort of lower volatility, right? And I really kind of think of that as a Goldilocks scenario, in terms of, you're potentially increasing your overall return while simultaneously lowering your risk. Right. And again, this is sort of in part due to the less liquid nature of these assets. And then, yeah, thanks, Maddie. Right. So this is just a bit on the fact that, individuals tend to be very underallocated to alternatives. And part of that has just been less product that's been available for individuals, right? And that's really changing, which I think is great. You can see here that institutional investors, so think, pension funds, whether they're public pension funds or corporate pension funds, endowments, foundations, sovereign wealth funds, they've been allocating to alternatives for decades, and exposures are generally anywhere from 20% to north of 40%. Um, we have there's a couple different figures out there. One I've seen is that individual investors only have about 3% of their overall allocation to alternatives. So portfolio construction conversations are always going to center around an individual's liquidity needs and risk tolerance. But from my standpoint, I would say, we kind of believe that, a 20% bogey is what you should strive for, with alternatives to really reap the benefits, right? And you see some of those potential benefits on the right-hand side, some of which, I've already mentioned, right? Really sort of diversification, return enhancement, the potential for greater income, and sort of lower volatility. So we can move to the next slide. Right. And again, I touched on some of this, but thinking about sort of the role that each of these plays, and look, there's always going to be, I'd say, sort of outliers or different ways that people may package a strategy or implement a strategy. But broadly speaking, you can think of private equity as giving you the potential for higher returns through long-term capital appreciation. Private credit, you can think of as an alternative source of income, also sort of enhanced income. And again, part of that is due to the floating rate nature of a lot of these securities. And then finally, you've got, real assets. which can provide both capital appreciation and income. They really are a great diversifier and sort of a natural inflation hedge.
Oh, and can I ask a question here?
Yeah.
Just like maybe this is coming in the future slide, but when people hear the idea of like illiquid, or when we bandy about in our business the notion of permanent capital, which is like every investor and advisor's dream, right? The idea of being
Yeah.
gainfully employed forever. But can you just speak to like the genesis, or the life cycle for a traditional investment for a client, whether it's in the private credit, private equity, or private real estate, or private real asset space? Excuse me.
Yeah, for sure. So I would say historically, the way that you could get access to alternatives, it was typically for qualified purchasers, and that was usually into a drawdown style fund. So that fund probably has a, call it roughly a 10-year life. And if I'm an investor, I would make a commitment to that fund. And then as that fund recognizes or identifies investment opportunities, they'll call my capital, they'll invest my capital, and then at some point they'll start to, harvest those investments and return my capital. What we've really seen though, over the past 5 to 10 years is a growing amount of sort of evergreen funds, right? So things that look a little similar to a mutual fund. Um, and they don't have the same exact liquidity, right? We really kind of refer to them as semi-liquid funds. Um, but if you're investing in performing real estate or performing private credit, a lot of those investments kick off income, right? And so you can put those assets in an open-ended fund that allows you to offer your investors potential liquidity. So a lot of the funds out there today will offer up to 5% of the fund's overall size in liquidity each quarter. And so, you're still able to, I guess, tap into some of that less liquid nature, but it's not quite as locked up, let's say, as that sort of traditional 10-year drawdown fund. The other thing to note about a lot of these new products is that they issue a 1099 instead of a K1, and they typically accept subscriptions on a monthly or a quarterly basis. So overall, it's just a lot more. I kind of refer to it as like user friendly, right? Than some of these traditional funds. Um, if you're talking about maybe like a distressed debt opportunity or a venture capital fund, then those are probably still going to be best accessed through that sort of traditional drawdown vehicle. But for some more, I'll call it like, performing strategies, or, we're going to get a little bit more into private equity in a second. A lot of these open-ended funds are sort of great forays into gaining, private markets exposure. So hopefully that helps
That's
answer your
super. Yeah, that's
question.
it. I mean, I think people just like, oh, geez, I'm 65. I want to lock up an investment for 10 or 20 years, and it's often not that long. Some instances it can be, and again, to your point, it's more VC or other kind of special situation workouts. But I'll let you take the back control of the presentation. I see there's a question in the question and answer one in the queue. We'll come back to that one shortly.
Okay, great. Yeah. So, and I want to be cognizant of time. So, right, private equity sort of talked about the potential for enhanced returns, right? And there's just a much larger opportunity set here, right? There are many more companies that are private than there are public, and we've seen, public market companies shrinking over time. So we can actually move to the next slide. So this just goes a little bit more into kind of the main sub strategies within private equity, right? So venture capital, typically going to be the riskiest, the longest, probably duration as well. And this is really, trying to identify new ideas or companies that could eventually sort of help change the economy. Growth equity is sort of the next leg in that stool. So typically, a venture capital investor may back a company. That company maybe, the whatever their business is or their product it achieves its proof of concept, right? It starts to grow, it starts to scale more. Then they would typically look to a growth equity investor to help them continue to expand and grow. Um, right. So that's sort of the next leg in the evolution, and then finally you've got buyout, which is most of what is in the private equity market. And this is typically, a more mature company that maybe is, underperforming for a specific reason, or a private equity firm has just identified, hey, we like XYZ company. We think they can do these three things better. Right. So they'll pool assets to buy that company and sort of enact a value creation plan. And then we've got secondaries. And basically, what a secondary is when this is typically when sort of an institutional investor, so think the teacher's pension of New York State would invest into one of an underlying private equity company, but they determine, what, we don't want to keep holding this 10-year fund. So they go out and they look to sell it. And so secondary investors will buy those stakes in an existing private equity fund at a discount. And they're really trying to look through to the underlying companies to express sort of their view of value. Maybe they're valuing this company at 5 times EBITDA, and we really think it should be trading for 8 times EBITDA. So that's sort of part of the way that they will help to gain value there. And the market for secondaries has really grown. Again, a lot of the sort of open-ended private equity fund tender offer funds that are in market today give you a nice uh, mix of nice exposure into secondaries, which sort of mitigate a traditional J curve, and there's no blind pool risk, right? You know what you're buying into. Whereas if you were to make a primary commitment to any of the other strategies I mentioned, typically you're doing that before the portfolio has sort of been fully invested. We can go to the next slide. Yeah, I think this is just, again, sort of hammering home the idea that one, companies are staying private for longer, and that a lot of the value creation is happening before a company actually goes public, right? And so investing in private equity is sort of allowing you to tap into some of those opportunities. And then, yeah, in terms of private credit, right, we touched on some of this, the enhanced for yield potential, diversification, as well as protection features, excuse me. So typically a private credit loan is, a bilateral negotiation between the lender and the borrower, right? And so what a lot of these private credit firms will do is put in certain covenants that sort of act like a speed bump to make sure that the company is performing as initially underwritten. And if the company's not performing as it's underwritten, they might trip one of those covenants, which then puts the borrower and the lender at the table sort of earlier to discuss, what do we need to do differently, right? Maybe we need to maybe we need to lower sort of our customer acquisition efforts, right? And divert that cash flow elsewhere. And so sort of within middle market direct lending, we typically break it down into three segments. You have sort of the upper middle market, which we would typically define as companies with, 100, 150 plus million of EBITDA. You have sort of the core or traditional market, which, anywhere from sort of 25 up to 75 or 100 million in EBITDA. And then you sort of have the lower middle market, which is really companies 25 million or less in EBITDA. Today there's a number of attractive non-traded BDCs out there that sort of hit on each market segment. And we can actually flip to the next slide, right? And so we've talked a lot about direct lending so far, which is really sort of the most common form of private credit exposure out there. Asset-based lending is an interesting area. It's one that we're starting to see more and more product come out very similar to direct lending. The difference being, it's a hard asset that is basically the collateral on the loan, as opposed to, the company's assets. And then, subordinated debt, I'd say this is an area of the market that is probably a little less active. You see it more allocated, like institutions are typically allocating here. When we talk about direct lending, we're typically talking about sort of senior debt, so kind of a first lien loan, right? That's sitting at the top of the capital structure. The subordinated debt is going to be below that. It tends to be fixed rate. And then finally, we've got distressed debt in special situations. This is typically going to be best accessed through, one of those longer life drawdown vehicles. And this is really for companies that are, going through Chapter 11 bankruptcy, right? And typically the return there is going to be more in the form of capital appreciation, as opposed to current income. And then just to, round it out, right? Real assets, um, again, enhanced return and income potential, as I mentioned, sort of sitting in the middle of that Venn diagram of private equity and private credit, as well as really nice diversification and inflation hedge potentials, right? And this is really giving you sort of tangible exposure to real estate assets, infrastructure assets, or natural resources. Real estate assets are often characterized as investments with contracted cash flows that will offer inflationary protection. Examples are multifamily housing, right, with sort of year-long leases that are negotiated annually, or a power utility owned by a large infrastructure platform that can sort of adjust prices on a monthly basis based on consumption, supply, or sort of other factors. And again, broadly speaking, these assets show very low correlation to public markets and even other private market asset classes. Some figures we've seen when sort of looking at a 15-year quarterly data, private infrastructure has a, negative 0.2 to 0.2 correlation. Private real estate is sort of negative 0.3 to 0.2, and then natural resources is right around, 0.3 to 0.4. So, right, generally much lower correlation, which we like. Infrastructure, right, as I mentioned, you can get, again, elements of both sort of equity and credit here. Think of things like power generation, midstream pipelines, electricity distribution, data centers, airports. Natural resources can include things like farmland, oil and gas type assets or exploration assets, as well as sort of other metals and minerals. So that's really what I had sort of in terms of my prepared comments, and I realize we're just coming up on the half hour, so happy to take any questions.
Oh, and let me first just address, like, that was awesome to get that much content into a, call it 20-25 minute window. So grateful for that. We had one question from an audience member relative to does private equity mean essentially buying a company like, let's call SpaceX an
Hmm.
example, where, hey, I'm expecting them to go public in the near future. If you could just expand on that, I'm happy to talk to it, unless you want to run with that. But I think there's a key
Yeah,
distinction there. There's private markets, and then there's private equity. So, if you don't want to mind taking that one, I'll leave that one to you.
yeah, for sure. So, right, one, I would just say it depends. Not all companies are necessarily looking to go public. A lot of times, the a lot of the private equity exposure that you'll see out there, they might be selling that private company to another private equity sponsor or to a strategic buyer, right? Think maybe a corporation, right? So SpaceX is definitely an example of a private company that is transacted in the private markets. Really, what you're tending to buy, though, it's not like warrants. It's, you're actually an owner of the equity in that specific company. I would say that, the main difference being, that equity isn't publicly traded, right, on an exchange or anything like that. So whether you're getting it maybe, directly as an individual, or you're getting that exposure, through a fund, whereby the fund is an owner in the company.
Yeah.
Hopefully that sort of
It's great. No,
helps
great.
clear it
Look,
up.
and I think that was one of the things you just hit on the last point there, which I want to make a clear distinction. So a couple of things is like, as you go into the private markets, so there's companies like EquityZen and whatnot, as a buyer, you're actually paying generally a pretty big premium over what the last valuation was. As a seller, often I'm selling at a price considerably below the last valuation. So there's a real significant distortion in the net asset value versus the market price. But a lot of what we're seeing for clients who do want to get into some of these popular non-publicly traded companies is you're doing it through a fund structure, and so the fund is
Mhm.
really the underlying owner of the asset. Now,
Yep.
if the stock continues to go up, they do another capital raise and whatnot. You'll see some sort of expression of your return in the form of a price appreciation, but not necessarily that, hey, all of a sudden the funding company goes public and we're going to send you your 100 shares or 50 shares, right? So
Yeah, exactly. Right. And I would say that's a little bit even more on sort of the venture or growth side of things, right?
sure.
These are maybe slightly less mature companies, or just ones that have stayed private for longer. So yeah, and look, it's a little bit the nature of the beast of private markets in terms of, trying to come up with sort of what is quote unquote fair value, right? I mean, I think one of the benefits is that a lot of these assets are sort of less impacted by investor sentiment, right? Whereby if you're talking about a public equity, there could be a negative headline and all of a sudden that sells off massively. Obviously, those negative headlines can still affect private companies, but there's generally, you're sort of less able to transact in such a quick manner. So that sort of helps to potentially insulate some of your downside.
Well, look, hey, we appreciate the time, Owen. Thank you so much. We fully anticipate continuing to our partnership with iCapital, and I'm sure clients took a lot away from what you had to say. So I'll let you enjoy the rest of your afternoon. Let me come back to
Awesome. Thank you so much.
thank you, reintroducing Adrian. Again, Maddie kind of put me in the spot as she does from time to time. So when he is not moonlighting on Succession, he's a doppelganger for Alexander Skarsgård, the actor. He is a lecturer, within the digital asset space, well known throughout parts of Europe. He spends half of his time in Zurich, half of his time in San Francisco, probably a little bit of time in New York as well, the financial capital world. But again, we're really excited to have Adrian Fritz from 21 Shares take us through the world of crypto. So, Adrian, the floor is yours. Thank you again for giving us your time this evening.
Wonderful. Thank you so much for that lovely introduction. I know we only have 30 minutes today for a topic which I could spend 30 days, 30 years on talking about. But for today, I just want to kind of give like a first level of introduction into the crypto asset space. And even though there's so much things to cover, we're just going to start a bit with the basics. Let me quickly share my screen here. All right, does that work?
Looks good.
Looks good, perfect. So maybe before we jump in, just a few words around 21 Shares, who we are and what we do. Jeff mentioned it earlier. We are a crypto asset manager with global presence. We are a ETF and ETP provider. And what we basically do is we wrap digital assets in financial regulated products and list them on different stock exchanges. We have a track record of 7 years. Our company has been founded and is based in Switzerland. And especially in Europe, the regulatory landscape is a bit more loose, I would say, or advanced, and therefore globally we now have 55 crypto products that we offer, and we serve over 16 markets globally. We now also have around 10 billion assets under management, but why we stand out in our opinion is because crypto and financial products is all we do. We really see ourselves as kind of like this bridge between the crypto asset world and the traditional world. And we try to bring those two worlds together. And we do this obviously through our product innovation. So an ETF, ETP is very accessible to everybody. We do this with our operational excellence, but most importantly, we do it with our crypto research because we know it's a topic that is very polarizing. There's a lot of misconceptions, and that's why we as 21 Shares, we really try to help investors, clients, or anyone that's interested just to understand the space and really help them navigate through this new asset class. What we see here is basically just kind of like our AUM development over the last couple of years. We can see we started here in 2018 in Switzerland, but expanded to Australia. And beginning of last year, we also entered the US market. As you can see, the US being the biggest capital market, it was quite a nice boost for our AUM overall. But again, we really serve markets globally, and we really want to make crypto investing as easy as possible. Now, let's jump into a bit of the basics in terms of education. I always like to start from scratch because I would really want to start with the blockchain itself. Ask yourself, do you know how the blockchain actually works? Let's say you're having dinner with your family and someone asks you, what is the blockchain? How does it work? Do you know how to explain it? Mostly, we all might have kind of like an idea, but we can't really explain it. And that's where I want to start. I want to explain the blockchain in easy terms. So how I always like to explain it is, imagine we have an empty piece of paper here. And I sent Jeff, for instance, I sent you 5 Bitcoin. We write down this transaction here on this piece of paper. Then maybe I sent you 10 Bitcoin. We write down this transaction on this piece of paper. We all send each other transactions, and each transactions we record on this piece of paper. At one point, it's full. There's no space left. What I'm going to do then is I'm going to hold it in the middle. We're all going to look at it, and we're going to ask ourselves, did this really happen? Are all the transactions correct and valid? And if the majority of us says yes, then we validate this piece of paper and we settle this block. And then we start from scratch with a new piece of paper. Transaction, validation, settlement. And that's basically how we get a chain of validated transaction blocks, which is the blockchain. Now, sounds easy, right? The beauty is that we all have a copy and it's completely transparent, meaning all of us, we can see what happened a minute ago, we can see what happened 5 days ago, we can see what happened 5 years ago, because all the transactions are transparent and any one of us has access to it. Again, the concept is really easy. Now, why is there such a hype around blockchain technology? What does it actually solve? What it solves is a really big problem of the internet, which is called the double spending problem. What is the double spending problem? It basically means if, for instance, Thomas, I sent you a photo, you share it with your friends and with your family, and they share it with their friends and family. At one point, we can't really identify where the original is coming from. While this might be okay for data, for photos, maybe for music, it doesn't really work when we talk about money or when we talk about assets or anything that holds value. And that, again, that's where the blockchain comes in place, because all of us, every point in time, we can identify and verify who holds the asset. And again, this technology is really the backbone, or basically the foundation for the new generation of the internet, because all this is basically a piece of code, a protocol. We remember the internet in the early 2000s. It's nothing else than an information protocol. It allows us to exchange information very rapidly, very cheap, cost efficient, globally. Now, the same is going to happen with assets, with value, with money, anything that holds value. And based on that concept, we will see a lot of new innovation, a lot of new products, services, and companies, like we did with the internet, with our Ubers, with our Spotify, Airbnb, and so on and so forth. Now, what does it have to do with crypto assets? Here we come to the first big use case and basically what brought the blockchain to the mainstream. It is Bitcoin. What is Bitcoin? Obviously, Bitcoin uses the blockchain technology as an underlying infrastructure, but the key takeaway is Bitcoin really serves as a digital store of value. It's a hedge against counterparty risk, and it's a portfolio diversifier. I always like to start with the key takeaways at the very beginning because we're going to talk about them and revisit them at the end. How does Bitcoin actually work? Again, it uses the blockchain technology, and Bitcoin has been created during the financial crisis in 2008. And Satoshi Nakamoto, which is an unknown founder, no one knows who he is, he introduced Bitcoin because he wanted to create a monetary system that works completely outside of the control of any centralized entity. And the beauty around Bitcoin is that it's a predefined monetary system. What does it mean? Well, first, it means it works completely opposed to our traditional financial world, where the global money supply is basically directed by the central banks. But Bitcoin, it's all based on code. It's predefined and pre-coded. Now, you remember the pieces of blocks here. Of course, it's not just the four of us here in this call. In Bitcoin, in the Bitcoin network, it's a network of computers, a decentralized network of computers that do nothing else than validating these transactions. Now, obviously, the four of us, we're not going to do this for free, right? I'm not going to put in all the work and don't get rewarded for validating all those transactions. The same happens with Bitcoin. Every time, and it happens every 10 minutes when a piece of paper is being settled, new Bitcoin are being issued into existence. And think about it like this. In 2009, when Bitcoin started, there were 0 Bitcoin in existence. And then 10 minutes later, the first block has been settled. And then suddenly we had 50 Bitcoin in existence as a reward for our work. So it's been distributed to us. Another 10 minutes later was 100 Bitcoin in circulation. Another 10 minutes, 150, and so on and so forth. And every 4 years, these block rewards are being cut in half. It's also predefined. Every 210,000 blocks, which is around every 4 years, these block rewards are being cut in half. So what that means basically is that at the very beginning, we had a lot of issuance and the circulating supply increased dramatically, while now over the years, we're going towards a limited supply. And the limited supply of Bitcoin is 21 million. Little side note, this is also the reason why we call 21 shares as an homage to Bitcoin's 21 million Bitcoin. Now, as you can see here on the graph is at the very beginning, the supply increased drastically, while now it's a marginal increase. And we're already at around 19.6 million Bitcoin in circulation. Now, why am I talking about this? This is a scarce asset. It's controlled by nobody, but it's accessible to everybody. And that's a big, big value proposition that you can have nowadays. And of course, it's being compared to gold. We all remember gold is the traditional store of value, which is also dubbed to be limited, but it has been serving us as a store of value for hundreds of years. And because of that limited supply, Bitcoin is emerging as a digital gold or emerging store of value. Now, the big difference is obviously I can send Bitcoin around the globe 24/7. I can send billions of dollars in value within 10 minutes, so to speak, while with gold, that's not feasible. Also, it's way harder to store gold, while for Bitcoin, it's basically all digital. Now, of course, because it's a scarce asset once again, and it has a limited supply, that's where it's deriving most of its value. We get this question quite a lot. How do you value Bitcoin? And it's some sort philosophical question, but it also has some fundamentals. Now, if you think about gold, for instance, gold has an 18 trillion market cap. And it's the biggest asset in the world. I would argue that 18 trillion doesn't come from the utility for jewelry or, I don't know, for electronics, which is one part of the valuation. The bigger part of the valuation comes through its scarcity and from us believing that it serves as a store of value. It's very similar for Bitcoin. Bitcoin, on the one hand, the valuation is driven by us believing that it can serve as a store of value because it has a limited supply. That's one part, obviously. The other part is that we here have a neutral, decentralized system that allows us to send value across the globe, like the internet. And again, being censorship resistant and being limited, it really starts to act as a hedge against inflation, but also a hedge against counterparty risk. And we see this in kind of like the adoption numbers in certain countries, especially in countries where we have high inflation or where we have capital controls or geopolitical tensions, we see a higher Bitcoin adoption rate. So countries like Argentina, Venezuela, or even in Ukraine, we see a lot of people moving towards this emerging store of value. But also in the US, I mean, in the US, a lot is changing right now with the regulatory changes and the new administration. And it seems like the US sooner or later might adopt Bitcoin as a strategic reserve asset. We had Donald Trump signing an executive order around digital assets that had a lot of different topics. But one topic spoke about a so-called digital asset stockpile, basically adopting crypto assets, especially Bitcoin, as a strategic reserve. Now, in my opinion, this might take a bit longer until it actually goes through Congress and becomes law. But we clearly see this adoption of Bitcoin already on a state level. At the moment, there's over 20 US states out there that already proposed a bill to adopt Bitcoin as a reserve asset, which is quite fascinating to see, in my opinion. And again, here it really comes down to supply and demand dynamics, because obviously the supply is limited while the demand will increase with more adoption down the line. Now, in terms of adoption, here we have crypto and Bitcoin in comparison to other technologies, but especially the internet. And we can clearly see that it's following a similar adoption rate. We're kind of like, if you think about the internet, it feels like the end of the 90s now. So we're at the very, when I talk about crypto, it's still very early, but we're starting to see some real use cases and some real adoption. Now, for Bitcoin, one big argument that we always get from potential investors is it's a very volatile asset. It's way too volatile. Yes, it is still a volatile asset, but it has been decreasing significantly. And obviously, this comes with more institutional adoption, with more market maturity. And just looking at the chart here, we can clearly see that the volatility is trending down. And therefore, it becomes much more interesting and attractive also for traditional investors. Now, this part is really important because it's a low, the correlation of Bitcoin is very, very low compared to other traditional asset classes. So as you can see here, if we compare the correlation, for instance, to US equities or US treasuries, we can see that the correlation historically has been really low. Also to gold, actually. The correlation between gold and Bitcoin has been really low, even though they serve some sort of, they have the same value proposition. The correlation between the two is quite low. Now, why is this important? This should excite every portfolio manager in the world. We are witnessing the emergence of a new asset class. And here you have an asset that is decorrelated to all the other assets. And therefore, it's just a wonderful tool for portfolio allocation and for portfolio construction. So here we have kind of like an example where we look at a traditional 60-40 portfolio, as you can see on the very left. And here we have a time horizon from 2020 until September 24. And if we look at the 60-40 portfolio, we can see that the annualized return was at around almost 9%. Now, here on the right, all those different columns, we have a 5% Bitcoin allocation, but with different rebalancing strategies. Now, what we can see is that in any case, the annualized return increased. So for instance, if we look at the very right, we can see it went up to even 14%. Now, the big problem is the row below. So the annualized volatility for the benchmark portfolio was around 9%. But with no rebalancing, it jumps up to 13%, which might not be acceptable for the overall portfolio. However, and that's kind of like the key takeaway we see over and over again, is really that rebalancing is key. So if we really go with kind of like a quarterly or annual rebalancing, we can see that we're able to capture the upside potential of Bitcoin while also mitigating the downside, which is expressed in a higher Sharpe ratio. So that's kind of like where it really helped because of its low correlation and because of its characteristics. It helps the overall portfolio. Now, let's get back to my key takeaways. Again, those are the value propositions of Bitcoin. It is a digital store of value. It's really emerging due to its limited supply of 21 million. It really starts to become a new digital gold. A hedge against counterparty risk. Again, Bitcoin is completely neutral and decentralized. There's no central bank, there's no central entity, and therefore Bitcoin is an asset, maybe one of the only assets out there that doesn't have any counterparty risk. And lastly, it's a portfolio diversifier. As we see in low correlation and potential improved Sharpe ratio, makes it a potential good addition for a portfolio. Now, the beauty here is, depending on from where you look at it, the value proposition changes. Like a hedge against counterparty risk might be more relevant in a country like Ukraine or in Venezuela, where they have high inflation. While in Switzerland, for instance, or in the US, where inflation is more or less under control now, we might look at it as kind of an investment tool or a portfolio diversifier. And that's really the beauty of this asset. Now, I've been speaking a lot about Bitcoin, but obviously there's so many tokens out there in cryptocurrencies and crypto assets. And I understand it might be overwhelming at the very beginning. And it is, I can tell you, because this is like a new technology and a new asset class on top. But we see already, if we look beyond Bitcoin, a lot of different use cases. Now, out of 100,000 different cryptocurrencies, I would say 99% are trash. And it's kind of like a byproduct of this cutting edge technology. However, the ones that remain are really disruptive, and they're gonna change a lot of industries and the internet itself. The best example, for instance, would be something like Ethereum or Solana. You might have heard about that. Like Ethereum and Solana both use the blockchain technology, but they work very, very different. The value proposition is completely different. These two protocols, they act as a platform for innovation. So think about your Apple or your Microsoft of the early days of the internet. It's a platform that serves for entrepreneurs, programmers to build on top. And what can they build on top? One thing is, for instance, decentralized finance. We already seen like a lot of projects that use these platforms to build financial applications. Another big use case are stable coins. So stable coins are basically US dollars, but being traded and settled via the blockchain. Stable coins there's over 200 billion in stable coins now in circulation. And think about it as kind of like a way for cross-border payments, or just a way better way to transact peer-to-peer between entities. And lastly, and that's maybe the biggest topic, is tokenization. You might have heard about the trend of tokenization. Everybody speaks about it. Asset managers, financial institutions, they all experiment and talk about tokenization. What does it actually mean? What is tokenization? Tokenization basically means to, instead of trading an asset via the legacy financial rails, you use a blockchain. Why? Because it's much, much faster, cheaper, and more efficient. The best example is, let's say bonds, for instance. Sometimes they settle T+2, T+3. I know nowadays some assets, they might settle T+0, but the cash lag still takes a few business days, which is unbelievable nowadays. I can video call any of my friends around the globe 24/7 for absolutely $0. Why can I not do this with money or with assets? Well, with tokenization, that will be possible. The settlement, the clearing, everything happens instantly if using blockchain technology. And therefore, these big asset managers start experimenting with tokenization. Now, coming to my last part, and I know we're almost at time. Now, how are investors thinking about crypto? I think the biggest testament, now coming back to Bitcoin, were the Bitcoin ETF approvals in the US. So in January last year, the SEC finally approved the Bitcoin ETF, and it's been the most successful ETF launch in financial history. Spot Bitcoin ETFs were able to capture over 35 billion in net new assets. And if we look at the total AUM as of now, it's over 100 billion in these products. Now, just to put this a bit in perspective, if we're talking about Bitcoin terms, these ETFs, they accumulated over 500,000 Bitcoin last year. Now, let's think back around the predefined monetary system. There's 19.8 million Bitcoin in circulation. And at the moment, there's 165,000 Bitcoin coming or being issued on a yearly basis, 165K. These ETFs last year bought more than double the annualized issuance of Bitcoin. So that kind of like puts things in perspective, where it describes this exciting supply and demand dynamics of that asset. Now, who's investing? That's always the biggest question. It's a combination of a few different types. Of course, it is also retail driven. Retail makes up the biggest chunk of the investors. However, we do see institutional adoption. If we look at the 13F filings, for instance, we already see a lot of bigger asset managers. We see also a lot of hedge funds that start investing in Bitcoin. But if we look at the landscape also in Europe, and the same in the US, it's a lot of kind of like investment advisors, wealth managers, and a lot of family offices that start using Bitcoin as part of their portfolio and using ETFs as the best access product. Now, where are we in the cycle? The question is always, is it too late to buy Bitcoin? Obviously, I'm not giving financial advice here, but my team, we look a lot at kind of like different metrics, different on-chain indicators, a lot of technical aspects, and also the adoption rate. And overall, just looking at the historical patterns, but also the regulatory tailwinds at the moment, we think everyone should at least educate themselves and look at how it might add benefits to your portfolio. And I think that's it from my side, right on time, I would say.
Great job. No, for sure. And again, to your point, 30 days would be probably enough to get through, an undergrad course. But I had a couple quick questions. As I looked at obviously the slide that was, there were two slides that jumped out at us as we think a lot about when we do portfolio construction. One is the correlation piece, right? The idea that is not as much correlation, despite the fact that for the last couple of years, everyone's talked about Bitcoin is basically the NASDAQ on steroids. I think large cap growth was like at a 39% tracking error versus Bitcoin. But the other one was really interesting was like, how almost negatively correlated they are with long-term bonds. So what I'm going with that is when you had the kind of 5% Bitcoin allocation in the different models, did that come at the expense of equities because it's more of a volatile asset, or did it come at the expense of debt because just the return profile is less attractive on fixed income? How did you guys think about that, or maybe it was some combination of both?
Yeah. I mean, in that example, we did kind of like a combination of both. And of course, it really depends on the individual portfolio. But we do think like that. Bitcoin is a digital commodity, and therefore it should be an alternative asset and maybe sit next to precious metal, or should sit next to gold. Now, when it comes to more something like Solana or Ethereum, which serve as kind of like a platform for innovation, kind of like a global app store, we think those are more of tech plays, actually. So here we see it more sitting next to tech equities. So obviously you have your traditional Web2 tech shares and tech equities, and here that's something where Solana or Ethereum could sit in. But Bitcoin is really kind of like on its own. Bitcoin is a clear winner in its vertical, and then you have kind of like the longer tail of crypto assets.
It's interesting, yeah, because I think again, there's the perception it's a monolith. Like we're crypto, and everyone again thinks only about Bitcoin, but then again they're anchored to, hey, it's $90,000 or wherever it is today.
Yeah,
it's expensive, right? But like as you unpack the different moving parts of the supply demand imbalance, somewhat enlightening. Let me just see if we have any questions from the audience. I think that probably truly from a technical perspective, a lot for people to absorb or to process. So I don't see any clients. That being said, Maddie, Tom, anything you want to run by Adrian? Otherwise, we'll let him again wrap his day up. He was kind enough to give us on a 6-hour time difference his evening. So if he's got kids to tuck in or a wife to apologize for interfering with his evening, we appreciate
no, it's all good. It's all good. I hope we only scratched the surface obviously here, but again, I think it's a topic, especially in the financial world, that can't be ignored anymore, and people should at least take a look. And again, you said it perfectly. A lot of times we talk about crypto assets and we think they're all the same, but just like with a lot of internet companies, they might be all based on the internet, something like a Spotify or a Uber, but the business model, the value proposition, the service is completely different. And here it's really the same.
Got it. Makes sense.
Could I ask just a very quick question?
Of course.
Just more kind of what you see coming down the road as it relates to products. So when you think of the picks and shovel type of coins, as you said, 99% of them are probably trash. But as you think about, the things that are building blocks within the crypto universe, do you see that being, an ETF that you would add in the future where it is kind of diversified over, many different verticals, I guess, as you described it, you know, different areas within crypto.
Yeah. That's a very good question, and I could talk about product innovation in crypto for a while as well because it's super exciting. But I would agree with you. I do think we will see more kind of like single offerings, single ETFs. But down the line, I'm pretty sure investors might be looking at something that is more of a basket solution. Maybe looking at something kind of like the S&P of the digital asset space. That's what I would expect.
Thank you so much.
Folks, look, we'll let our guest speakers go. Adrian, thank you so much. Owen has already left the building, but this was great. You know, we really we learned a lot. I know I did take notes throughout the discussion, and you know, constantly kind of evolving our practice and process. So you know, continue to share with us your feedback relative to what you want to hear and see, and we'll you know, hopefully bring really wonderful speakers to the floor. So have a great rest of your day, evening, morning, whatever it is. You know, we look forward to seeing you next month on our webinar series. Take care.
Thank you.
Bye-bye.